So there's a strategy that's all over YouTube and the rest of the internet right now. Put your kids on payroll, take the deduction, pay zero taxes. There are parts of it that are true, but like a lot of things involving tax advice on the internet, there are a lot of mistakes being made as well. The version you're being told is missing about 4 things that actually matter, and those 4 things are the difference between a clean tax strategy and an unsuccessful IRS audit. So let's go through what you've been told versus what actually works. So here's why this is a pretty interesting topic. Theoretically, as a business owner that's making some money, you are in a significantly higher tax bracket than your children are. So the idea is if you employ your children in your business and you pay them income, it kind of keeps the money in the family, but the money that they're paid is at a much lower income tax rate. In fact, it may be not subject to any federal income tax at all. So the basic idea is pretty simple. If your child does real work for your business and you pay them a reasonable wage, that pay can be deductible to the business. It's an expense. And then if your child's total taxable income stays within the 2026 standard deduction, which is $16,100, they may owe no federal income tax on those wages. But there are a lot of guardrails to worry about here. So you've been told just put your kids on your business payroll and you'll save on income taxes and payroll taxes, or it'll be tax-free. But what actually works is this. The FICA exemption only works in a sole proprietorship or in a parent-only partnership, where parents are partners in that business, or if the parents own a disregarded LLC. And I think a lot of social media and YouTube advice skips the entity question entirely, but this FICA exemption under IRC 3121, and if you want to get really specific, IRC 3121 B3A, it's explicit. It applies to services performed by a child under 18 in the employ of his or her father or mother. This means that S Corps, C Corps, partnerships with non-parent partners don't qualify for this exemption. In those entities, the full FICA and FUTA are going to apply. A sole proprietorship or a single member LLC taxed as a disregarded entity can also qualify, but the moment that LLC elects S Corp status, which is obviously very common, that particular exemption disappears, even though you can still save on the income taxes potentially. So if you picked an S Corporation status and you had good reasons somewhere else in your tax strategy, fine, great, but you don't get this part of the benefit. And here's the dollar difference. $10,000 in wages through a sole prop can save about $1,500 in FICA. The same wages through an S Corp, you don't save those FICA taxes. You will potentially save the income tax rate, which is still thousands of dollars. And I don't think anybody on YouTube mentions this because it doesn't fit into a 60-second clip. Surprise, surprise, tax law is pretty nuanced, but it's one of the first questions you should be asking is how is your entity set up? All right, so now the second myth. You've been told to put your kid on payroll and figure out later what they'll do. Just pay them some wage. And that's totally backwards. What actually works is this. Your kid needs to do real age-appropriate work, and you need to document it like you would for any other employee. We have 2 kids, and a lot of people assume that both of them work in our business. Only one of them does, our 15-year-old. Our 8-year-old daughter does not have a job in our business because we haven't figured out anything for her to do where she makes enough money for this to be worthwhile for us. And this is how people often describe this. Decide to hire your kid, go find something for them to do. But the IRS sees that in the opposite order. The work comes first. The job description comes first. Then the payroll and the tax benefits follow. The IRS has successfully argued in tax court for deductions to be disallowed when there's no evidence of actual work being done. Taxpayers only survive that kind of scrutiny when they have contemporaneous documentation, which we talk a lot about on this channel. They've got assigned tasks, they've got a job description, and they've got proper payroll records like W-2. So what kind of work counts? Well, it really depends on the kid, their age, and what they're capable of. But it can range from administrative work to data entry, social media content, product photography, taking inventory, customer follow-up, video editing, running errands, answering phones. Our kid shows up at the office and processes and scans our mail. He cleans up the trash in the parking lot. We keep him pretty busy after school. So the real question is, what kind of documentation do you actually need for this to hold up? You need a job description. And frankly, it isn't just your kid that needs a job description. Every employee in your business should have a job description. You know who I'm talking about. You need timesheets or task logs that need to actually track the hours that they work. Pay stubs, of course, are helpful, and a W-2 at year end, just like any other employee. And ideally, you pay them through a payroll system or maybe by check but don't pay cash. And you should still probably file a tax return even if they owe zero. This is kind of fact specific. If they're under the standard deduction, sometimes there's an argument that you don't even need to file a return, but it can still be a good idea. Plus, we're going to talk about some strategies to supercharge the tax savings here. And in those cases, you're definitely going to want to file a return. And we get a lot of people saying, well, I'm just going to hire my kid as a model because the Gerber baby made a whole bunch of money. It doesn't really work like that, even if you think your kid is cuter than all the other kids out there. Here's the rule. Generally, if you wouldn't pay a stranger's kid to do this at the rate that you're paying it, the IRS isn't really going to believe that about your kids. All right, so now let's talk about myth number 3. You've been told pay your kids $16,100. It's all deductible and they pay nothing. Here's what actually works. Pay them what you'd pay a non-family employee for the same type of work. The deduction holds when the math holds. A lot of social media and YouTube tax advisors, I don't even want to use that word, so-called tax experts, push these made-up payroll formulas like paying your child some fixed percentage of profit or maxing out the standard deduction no matter what job that they do. That's not based on anything the IRS recognizes. Compensation has to reflect fair market value, not arbitrary profit splits or what you just think your kid is worth. So if you have a 10-year-old doing 5 hours a week of filing, that's like $12 an hour, $15 an hour, that may be $3,000 a year. That's defensible. But paying them $15,000 a year for the same work may be a stretch. If you want to pay that same kid $15,000, you need a very detailed task list and a very strong case that that salary is reasonable. Now, lawyers love the word reasonable because there's always room for interpretation, but we are going to look at market rates. We are going to look at things like the Bureau of Labor Statistics to see what comparable wages or salaries are. Now, here's where people get excited, and this part is real. In 2026, the standard deduction is $16,100. So wages or income at or below that amount can mean zero federal income tax for the child. Here's that example math. Let's say a business owner is in the 32% tax bracket and they pay their child $12,000 for documented work. That could create $3,840 in income tax saving. And if the business is a sole proprietor, it could also reduce the self-employment tax by around $1,700. So the child's federal income tax could be zero. You just moved all of that income from the higher rate to a zero rate. So all in all, that could create a net family benefit of around $5,500. That's not a loophole. That's the tax code applied correctly. The difference is in the documentation. Plus, let's also talk about the benefits of actually teaching your kids how to have a job and how to function in a workplace and how to add value to a business. These aren't tax benefits. These are life skills that you want your kid to be learning anyway. All right, so now on to the 4th myth. You've been told hire your kids, pay zero taxes. That, of course, is not accurate. What actually works is this. It's tax deductible for you and it's potentially income tax free for them up to that $16,100 and FICA exempt only in the right type of entity. That's 3 rules, not 1. This is the tagline that gets people in trouble. It's not zero taxes. It's 3 separate mechanisms, and each one has its own rules. Number 1, the business gets a deduction. Number 2, the child's income may fall under the standard deduction. And number 3, FICA is exempt only in qualifying entities. Income tax withholding can still technically be required, even if the child ultimately owes nothing. And if your documentation is weak, the IRS can reclassify the entire arrangement, causing you to pay more taxes. This means no deduction for you, potential gift tax issues, and back taxes with interest and potentially penalties. Plus, if the child earns above the $16,100, they will likely owe income tax on the amount over that threshold. And in an S-Corp, FICA applies to basically every dollar that they own. So the 5-word version of this strategy is designed for clicks. That version that actually works takes about 10 minutes to explain. That's what we're doing right now. And that's really the magic. The strategy is not put your kids on payroll. The strategy is employ your kids in the business. There's an important distinction there. So now let's hit the 5th myth. Maybe you've been told, set up payroll at the end of the year and backdate it. Just pay them for the entire year. Do not do that. What actually works is this. Set it up properly from the start with a payroll system, a regular pay schedule, quarterly filings, just like you do for your other employees. Some advisors may suggest after the fact payroll, where you retroactively reclassify draws as W-2 wages at year end. That can create problems real fast. IRS Form 941 requires quarterly payroll tax reporting. And depending on your payroll tax liability, you may have to pay deposits monthly or even semi-weekly. depending on your business. Dumping a full year into the fourth quarter with no prior filings can be a real red flag. And late payroll tax deposits can trigger trust fund recovery penalties of up to 100% of the unpaid amount. You can get in big trouble for this. And that gets applied personally to the business owner. A basic payroll provider usually costs like 30 to 50 bucks a month. And if you have employees, you already know this. That's basically the full cost of doing this correctly. It takes maybe 30 minutes to set up, but it protects the entire strategy. And here's the part almost nobody talks about. Most videos end with the deduction and the savings that you can get. That may be the most exciting part of this strategy, but the devil's going to be in the details. The real play is what happens next, because once your child has earned income, they actually become eligible for a Roth IRA. And that can change this entire conversation. In 2026, the Roth IRA contribution limit is $7,500, or the total amount of the child's earned income, whichever is less. There's no minimum age set by the IRS for contributing to a Roth IRA. So if a child has legitimate earned income, they can qualify for this. That account can be funded by the child through their wages, by you, by grandparents, by anyone. What matters is that the child had enough earned income to support the contribution. Every dollar that's put into that account is tax deferred, so they're not going to pay tax on it until hopefully retirement. So once the money goes into a Roth IRA, it grows tax-free, potentially forever. This is building real wealth for your children. This is the real play. So a child who starts investing early has an absurd advantage because compounding does the heavy lifting over time. If a child starts at age 10 and contributes $7,000 a year, by the time they turn 65, if they're getting an 8% return, which isn't completely outrageous, they could have $3.2 million in that account. At a 10% return, it could be over $6.1 million. God, I love compounding interest. If you started at age 18 with the same annual contribution, the value drops dramatically because of the value of that compounding interest. Starting at 25, it drops even more. Starting at 10, starting early instead of 25 years old with the same annual contribution can produce roughly 3 times the returns over time, even at 8% returns. 8 extra years of compounding can do more than 30 years of contributions later. That's how this math works. And this is part that the internet usually skips as well, because there's more rules and there's more compliance and it's more complex. But we're talking tax savings and wealth building and teaching the kid life skills by working in your business. Sign me up. You get the business expense, you reduce or eliminate your child's federal income tax, and you potentially funded a retirement account that could compound for 50 years. This isn't a hack. This is what a tax strategist does. This is what a great tax strategy can do for you and your family. So let's pull this all together. Your entity matters. If you've got the sole prop or the disregarded LLC, not an S Corp, you can get that FICA exemption, but with the S Corp, you can still get huge income tax savings. Real work and real documentation matter. That means job descriptions, timesheets, payroll, W-2s. You got to pay reasonable wages. They matter. You got to pay market rate, not some arbitrary number that you heard in a reel. And it's not just tax-free, it's 3 separate rules working together. Set it up properly from the start, don't backdate your payroll and hope nobody notices, and tack on the real opportunity here, which is the Roth IRA, not just the tax deduction. Most of what you've seen on this topic is designed to get you to click. What I just showed you is designed to keep you out of an audit and help you build actual wealth for your kids. Those are completely different goals. If you want to know whether your specific structure qualifies or you want help setting up the right way, book a call with us. We can talk about it.